Okay, lots to talk about, including all that's moving in the market. But first, quick check on earnings. That's what the season is all about. And Dabur has posted numbers in line with estimates. Stocks now moving higher. And we have with us Mr. Sunil Duggal, CEO of the company, joining in. Mr. Duggal, thanks for being with us. Looks like a stable quarter at the start. Take us through how the business has been.
This looks pretty stable. The volume growths are intact at 9%. Revenue growth at around 13%. And all the key sectors of our business are faring quite well.
Can you take us through how volumes have done this quarter and overall how prices have moved?
Yeah, domestic consumer business has grown at 13%, out of which the volume part is 9% and price is 4%. So it's a little bit off what we saw in the fourth quarter of last year, which was an exceptional quarter, but then off a fairly high base of last year, 9% isn't too bad. So we are pretty satisfied with the volume growth trajectory for the domestic business. Overseas growth is almost entirely volume driven because there's precious little inflation happening in the overseas market, so we haven't taken up any price increases of note. So that's entirely volume.
You know, we're talking to you at a time when there's this raging debate in the market about consumer companies, whether they can actually continue with this level of volume growth. Basically, if the demand visibility is clearly there. What is your sense as you look at the next few months?
Well, I don't think anything can be taken for granted. If you take the sector as a whole, the FMCG sector, particularly the non-food part, has seen a sharp deceleration in growth over the last 1 year. So growths have almost halved, and I think that's something which we have to take into account. We have been fortunate that we've been able to buck the trend and show a fairly steady trajectory of growth. And that's perhaps because we have invested hugely in rural infrastructure, and rural growths have fallen much less than urban growth. So I think the outlook, while reasonably stable, is not all that benign, certainly not as good as what we saw a year ago. And we need to be a little cautious here in terms of how we conduct the business, need to protect margins because inflationary pressures are rearing up. So while the sector still remains very attractive, but nothing here should be taken for granted.
So should we expect 9 to 10% to be a number that's par for the course for the rest of the year as well, purely in terms of domestic volumes?
For us, we think so, yes. Again, not to be taken for granted, but I think 9 to 10% is something which we can deliver, and we've seen this in this quarter, and I think we are in a position to deliver that kind of growth.
Sure. So I want to come to the margin right now, and basically all the levers that are at work over here. I think 14.5% has been pretty stable, at least compared to last year. But how are different cost pressures playing out, whether it's raw material, whether it's spending on advertising? If you could just take us through the margin issues.
Yeah, the margin profile improved this year because of lower material costs in the first quarter. Now, having said that, we are seeing inflationary pressures come back a little bit in the second quarter, largely on account of the rupee depreciation, which happened substantially towards the end of the first quarter, and that's going to, hurt us a bit in the second quarter onwards. So we'll have to do some mitigating factors like price increases, etc. But the growth in margins, which we were anticipating, which would be substantial as far as the outlook a few months ago, will probably not happen. We'll be looking at best very modest increase in margins for the balance of the year.
What is the outlook on spends on advertising now?
Fairly steady. There's a fair amount of uncertainty because of the discord between TAM and the advertisers. So I think advertising may be muted in the short run consequent to that. Overall, I think the advertising trajectory would be reasonably robust. There won't be any sharp uptick in terms of advertising, but we don't intend to take down the spends too. So I think 13 to 14% A2S ratio is what we are forecasting for the rest of the year. I see no reason to change that, even though perhaps in the second quarter maybe a little bit less.
As we're going through this slightly challenging patch between the two businesses, food and non-food and pure consumer, which one would you think would be a key driver of growth for the rest of this year?
I think food would be significant in terms of driving growth, but there's also higher pressure as far as the food's margin profile is concerned. So it would help growth, but perhaps won't do any great good things to our margin profile. The home care business, the HPC business is something which would really be the driver of margin expansion. But at the same time, we would face pressures in terms of growth. So overall, we'll have to blend the growth of both these two businesses in a way which maximizes both our revenue and margins.
Sure. So finally, some last thoughts. as a significant corporate presence out there. How do you look at the environment? There's still a lot of gloom and doom talk. If you're looking at any kind of future financing, any more investment in capacities at all this year, and whether you see, so to speak, a turnaround somewhere near.
No, I think as far as we are concerned, this is an asset-light business. We will certainly not hold back on investments. We will be continuing to invest in both our brands as well as CapEx. But we have invested significantly in CapEx over the last 2-3 years, so I think this year our investments would be muted. But certainly the near-term gloom and doom, as you mentioned, is not going to have any impact on our spending plans.
Okay, good talking to you, Mr. Duggal. Thanks for joining in. Good luck for the rest of the year. Thank you.
Okay, let's also take